Order blocks are key areas in trading where traders look for high-probability trade opportunities. However, have you ever wondered why some order blocks work perfectly while others fail to gain any market reaction? To answer this question, we conducted over 100 backtests on order blocks under various market conditions. Our goal was to identify the characteristics of high-quality order blocks that the market consistently respects. Through extensive testing, we analyzed several rules to determine which ones effectively improve the win rate of order blocks. The results confirmed a crucial insight. Order blocks only work under specific conditions, when certain repetitive market patterns occur. In this video, we will cover the basic rules of trading with order blocks, backtesting results that highlight what makes an order block successful, conditions for high-probability order blocks, and how to increase your win rate. Let's start with how to identify the order block zone. To accurately mark an order block, we focus on the last candlestick that caused market inefficiency. This is where significant buying or selling decisions were made. Order blocks can appear at the beginning or in the middle of an impulsive move. They can take the form of a bullish or bearish candle. Color doesn't matter. There are 3 major rules for identifying valid order blocks. Rule number 1. It should cause the market inefficiency. But what is inefficiency? Market inefficiency occurs when the price makes sharp, one-sided moves, creating gaps between the wicks of candlesticks. Efficient price moves do not leave gaps, meaning price action has been balanced. Inefficient moves, on the other hand, signal that smart money has entered the market, leaving behind price imbalances that the market may revisit. When marking an order block, always check if the preceding move was inefficient. If no inefficiency exists, the order block may be weaker. Rule number 2. The inefficiency should lead to a market structure break or change of character. What does this mean? For an order block to be valid, the inefficient price move should result in either a break of structure or a change of character. A break of structure confirms trend continuation, while a change of character signals a potential trend reversal. A break of structure suggests that the market is maintaining its trend, making continuation order blocks more reliable. A change of character indicates that the market may be preparing to reverse, making reversal order blocks viable. If an order block does not lead to a break of structure or change of character, it has a lower probability of success. Rule number 3. Ensure the order block is unmitigated. What does unmitigated mean? An unmitigated order block is an order block whose price has not yet been revisited since its formation. Order blocks are one-time use zones. Once the price mitigates or touches an order block, its effectiveness decreases. We only consider fresh order blocks for high-probability trades. When analyzing potential trade setups, ensure that the price is returning to the order block for the first time, not after multiple tests. To trade order blocks successfully, always follow these 3 core rules in 3 steps. For example, in this Euro-USD 30-minute chart, in order to identify valid order blocks, we start from the left-hand side of the chart, looking for clear inefficiencies, sharp price moves that leave gaps between candlesticks. We mark the candlesticks responsible for creating this inefficiency as order blocks, but only if they result in a break of structure or a change of character. According to our rules, these order blocks are valid trading zones and potential high-probability setups. Here are our simple 3 steps for trading order blocks. 1. Identify a valid order block. 2. Place an order at the start of the order block zone when price retraces. 3. Set the stop loss at the end of the order block and target 2 times the stop loss range for profit. This method ensures that even with a win rate of just 34%, it remains profitable due to its strong risk-to-reward ratio. However, while this is our simplest method, we have developed an advanced trading strategy that offers lower risk and higher profitability. In order to find order blocks with low risk and higher profit, we backtested more than 100 order blocks. After reviewing the backtesting results, we discovered that trades have a higher chance of success when certain conditions are present with order blocks. Additionally, we observed repetitive patterns on the chart that significantly improved trading returns. So we summarized them in 4 factors that should be considered when identifying high-quality order blocks. But before we continue, I'd like to introduce you to Bybit. a trusted, high-speed global cryptocurrency exchange. Bybit offers a comprehensive suite of products including demo trading, spot and derivatives trading with up to 100x leverage, and access to Web3 services. But that's not all. Bybit provides even more opportunities to grow your assets. Plus, new users can claim a $50 welcome bonus simply by signing up and completing identity verification. The first factor you should consider is the market structure's specific patterns. Here are some of the most repetitive patterns that form on the chart every day. And the next time you see these patterns, you will be ready for it. So let's dive deeper into market structure patterns and how they influence order block effectiveness. Pattern number 1, the liquidity gap between two order blocks. Here we identify a valid order block, presenting a potential long trade opportunity. However, a second valid order block forms shortly after. As a result, there is a high probability that the price will drop to fill the gap and grab liquidity below the second order block before continuing the uptrend. This increases the likelihood that the second order block may be ignored, while the first order block has a higher chance of being revisited by the price. If two valid order blocks exist with a gap in between, we assign the second order block a -1 point, since it has a higher risk of failing due to liquidity grabs. Breaking below the second order block is not necessarily a reversal. It could simply be a liquidity grab before future price movements. Pattern number 2, liquidity sweep at equal lows. Here, a valid order block is identified. To the left side of the chart, price sweeps liquidity below equal lows, increasing the probability of a strong move upwards. When an order block sweeps liquidity above or below equal highs or lows, it gets a +1 point, as this signals strong institutional accumulation for future price movements. Pattern number 3, stop loss clusters below support levels. Similar to the second pattern, the equal lows work as a support level for retail traders. This causes liquidity to accumulate under the equal lows, and even smart money traders like me and you will put our stop loss at the end of this order block zone. The market always is going to haunt these stop orders, so this is the market dynamic move, and it is likely to sweep this liquidity, so you need to have this vision if you want to win against the market. Just look back at these situations to confirm if there is another entry. In situations like this order block has more chance to reverse the price, while many traders lose their long position at this order block and support level, which may make them enter short to follow what they believe is a breakout. And this reaction fuels the reversal, allowing the market to trap these sellers before continuing its original direction. So this is what makes this order block, and what I taught you here, a unique experience that no one will share with you. The second factor you should consider is market fluctuation and spread. During our backtesting analysis, we observed most winning trades occurred during high volatility market sessions. Here are the key insights from backtesting. Low liquidity periods like the first and last trading days of the week tend to produce fewer successful trades. Midweek sessions offer the highest probability of success. Trading Euro-USD performs best during peak volatility hours like London and New York sessions. Low volatility trading periods like the late Asian session may result in weak market movements, reducing the effectiveness of order blocks. The market often reacts to order blocks with precision, sometimes within just a pip. High spreads can cause traders to miss profitable entries or trigger stop losses prematurely. To increase success rates, traders should prioritize low spread trading conditions and consider market fluctuations before executing trades. The third factor you should consider is market trends and freshness of order blocks. The effectiveness of order blocks depends on two key characteristics. The first one is market trend. Order blocks have a much higher success rate in trending markets compared to ranging ones. Trading in the direction of the dominant trend improves reliability. The second one is freshness of order blocks. Recently created order blocks are more effective because supply and demand are actively engaged in price movements. Waiting too long for price to revisit an order block reduces its effectiveness as market conditions are constantly evolving. For example, the market is clearly trending upward. New demand zones and order blocks are frequently formed, rejected, and then push the price higher. These fresh order blocks present high probability trading opportunities. On the other hand, look at this example. A valid order block exists, but before the price reaches it, multiple demand zones form and get broken. Some traders may interpret these zones as liquidity grabs and place buy orders at the order block. However, since supply has taken control, trading this order block without confirmation is risky. The key solution is to always check for confirmations in lower timeframes before placing trades, which is the fourth factor you should consider. One of the most effective ways to avoid unnecessary losses is to use confirmations on lower timeframes before entering a trade. The market doesn't always react perfectly to order blocks. Sometimes price ignores them completely. Confirmations help filter out weak setups and provide added confidence in trade execution. Once we identify an order block on a higher time frame, we zoom in 2 time frames lower to refine our entry. That's it, guys. These strategies work across all Forex pairs and timeframes, but backtesting is essential to determine which pairs perform best for your trading style. If you found this guide valuable, hit the like button and subscribe for more trading strategies. Thanks for watching and see you in the next episode.